Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Richard, Duncan, and Ira Harris. Richard is the author of 3 books on the global economic crisis. The Dollar Crisis, Causes, Consequences, Cures, predicted the global economic disaster that began in 2008 with extraordinary accuracy. It was an international bestseller. His second book was The Corruption of Capitalism, a strategy to rebalance the global economy and restore sustainable growth. And his latest book is The New Depression, The Breakdown of the Paper Money Economy. Richard has worked for ABN AMRO, the World Bank, and the IMF. And Ira is an independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also a CME director from 1997 to 2003, and also recently. Welcome, gentlemen.
Thank you for having me back on, Richard.
Yeah, this is a great pleasure and an honor to be able to sit here, Richard. You always introduce me to wonderful people, and here's the next one. Richard Duncan certainly speaks for himself, so let's go.
Sure, yes. I would start with an elaboration of your view of the economy, the creditism view, if you can elaborate on that, Richard, and how it affects the financial markets.
Okay, so I believe that when the United States stopped backing dollars with gold in 1968, in 68, Congress changed the law so that the Fed was no longer required to hold any gold whatsoever to back the dollars that it issued. I believe that fundamentally changed the way our economic system works. And up until then, we had been on the Bretton Woods system, or essentially a gold standard where money was backed by gold. And all of classical economic theory, or all of the orthodox economic theory, was built on the premise that money was gold. And this created a set of constraints that limited government policy, but also limited how the economies could work. And all of the economic theory was built around this premise that gold was money. Once that was no longer true, then many of the constraints that had been imposed on the economic system due to the gold standard, they disappeared. And our economic system began to evolve from, I believe, I like to say it evolved from capitalism into creditism. Now, what were the constraints that disappeared? Well, first of all, under a gold standard, or the Bretton Woods system, or any system where dollars had to be backed by gold, trade between countries had to balance. That's because if we were on a gold standard, if a country had a large trade deficit, then that country would have to send its gold to the country that had the trade surplus. And pretty soon, since gold was money, if the country had a large enough deficit, it would lose all of its gold. And it would have to stop buying things from other countries because it simply wouldn't have any more gold to buy the things with. So trade under a gold standard or the Bretton Woods system, it balanced. But once the Bretton Woods system broke down and gold was no longer money was no longer backed by gold, trade didn't have to balance anymore. And very quickly, the United States started running very large trade deficits with the rest of the world. By the mid-1980s, the US current account deficit was 3.5% of GDP. And by 2006, it peaked at 6% of GDP. That was $800 billion trade deficit that year. Now, the significance of this is once the United States discovered it could buy things from other countries and pay for them essentially on credit, pay for them with just paper dollars or more realistically treasury bonds, then what this meant was the United States was able to buy things from countries with very low cost labor. This ushered in the age of globalization, and it was extremely deflationary. Once we started buying goods from countries like China, where women were working in factories and making $3 a day, this put extreme downward pressure on US prices. And we started seeing extraordinary disinflation starting from 1980. And now we moved down to levels of inflation that have been quite close to zero. So as interest rates moved down, inflation moved down, therefore interest rates moved down. And what we discovered is that in this new age of globalization, with this extreme deflationary pressure, this allowed the US government to spend on a much larger scale than it had ever done before without causing high rates of inflation. And also we discovered that the Fed was able to create money on a mind-bogglingly large scale to help finance these budget deficits without leading to high rates of inflation. So, for instance, before, when we were on a gold-backed system, say in the 1960s, if the government spent too much and if the Fed created too much money, that tended to overstimulate the domestic economy. And that quickly led to domestic bottlenecks in labor and industrial capacity because we had a relatively closed US economy. But once gold stopped backing money, then suddenly we had a global economy. Our global economy now has nearly 8 billion people, and 2 billion of those people live on less than $3 a day, and would probably count themselves lucky to make $10 a day. So that means that our government has been able to have trillion-dollar budget deficits with the Fed creating trillions of dollars, and we still haven't had significant rates of inflation at the consumer price level. So that was one very important change. And the other change, of course, was that central banks were suddenly free to create as much money as they pleased, not only in the United States, but around the rest of the world as well. So countries like China, their central bank created a lot of their own money, and they used it to manipulate their currency. The PBOC, the People's Bank of China, would create yuan, and they would use those yuan to buy dollars to hold down the value of their currency relative to the dollar. And by holding down the value of their currency, they were able to support their export-led economic growth and ensure that their exports to the US continued to grow and grow. And that allowed China's economy to evolve into this extraordinary superpower that it is today. And once they accumulated all of these dollars, then they bought treasury bonds with them. And that put upward pressure on the treasury bond prices, and it drove the treasury bond yields down to extremely low levels. And this new force caused the Fed to lose control over interest rates because the People's Bank of China was buying so many treasury bonds, and that pushed the price of the bonds up and it pushed the price of the yields down. So for example, in 2004, 2005, 2006, the Fed was hiking the federal funds rate. During a 2-year period, they increased the federal funds rate by 425 basis points. Normally, that would have pushed up the 10-year bond yield sharply as well. But the 10-year bond yield didn't go up because the PBOC was creating so much money and buying so many treasury bonds, it was pushing up their price and driving down the yield. So that caused the Fed to lose control over interest rates. And that's because they couldn't push interest rates higher. That's one of the main reasons we got the property bubble in the US that blew up in 2008. So this is, I'm afraid, a long-winded explanation. Once dollars ceased to be backed by gold, what we saw is an explosion of credit in the US. So total credit total credit and total debt are equal to two sides of the same coin. What I mean by total debt is all the debt in the country: government debt, household sector debt, corporate debt, financial sector debt, all the debt. It first went through $1 trillion in 1964. Now it's 78 trillion. So it's increased 78 times in my lifetime. And this explosion of credit has become the main driver of economic growth in the US and around the world. So at the end of World War II, the ratio of total debt to GDP in the United States was something like 140%. It gradually increased to 160% by 1980. But after that, it absolutely exploded as credit grew much more rapidly than the economy. And by 2007, total debt to GDP in the US was 380%. So credit became the driver of economic growth. And as it did, our economic system evolved. It grew dependent on credit growth. This was quite different from the way that capitalism had worked. Capitalism was an economic system that was driven by saving and investment. Businessmen would invest, some of them would make a profit, they would save that profit, or in other words, accumulate capital, hence capitalism, and repeat. They would invest it again. And it was pretty slow and difficult, but that's the way capitalism generated economic growth. That's just not the way our economic system works these days. Our economic system now for decades has not been driven by saving and investment. Instead, it's been driven by credit creation and consumption, more credit creation and more consumption. And this generated very rapid economic growth all around the world, and in fact pulled literally hundreds of millions of people out of poverty around the world. The problem is this new economic system, which I call creditism instead of capitalism, since it's driven by credit instead of capital accumulation. This economic system requires credit growth to survive. And anytime credit adjusted for inflation in the US grows by less than 2%, the US goes into recession. That happened 9 times between 1952 and 2009. And the recessions don't end until we get another big surge of credit creation. So our economy is built on credit. The global economy is built on credit. And if credit begins to contract, we have a depression. That's what we started to see in 2008, 2009. But at that point, the private sector was too heavily indebted to keep borrowing. So the government sector jumped in and started borrowing. They ran $1 trillion budget deficits in the US for 4 years in a row. And the Fed helped finance those by creating $3.5 trillion over 7 years. And that reflated the US economy. And we saw the longest expansion in economic growth in history up until the time the coronavirus struck the US earlier this year. So that's what I mean about the economy evolving. Our economic system has evolved from capitalism to creditism, and we're now dependent on credit growth to keep the economic system from collapsing.
Interesting. And given this view, what are your thoughts on the current effects of the pandemic on the economy and the financial markets? How do you see it playing out from a creditism point of view?
Well, so this pandemic is a real threat, of course, to creditism, because so many people have lost their jobs. How can they possibly, without government support, how could they possibly pay their rent or their mortgages or their car payments or their credit cards? And if people in the private sector, if individuals stop spending, as they would have had to do without government support, then small and medium-sized businesses would collapse by the hundreds of thousands, and the corporations would as well. Therefore, they would all default on their debt, and consequently, all of the US banks would have failed by now. Because in a best case scenario, banks have 10% capital relative to their assets. And their assets are the loans that they have made and the investments they have made. So it would have, in a scenario without the government support, their capital would have been destroyed many times over by now. And all of the banks would have failed and would have had to have been bailed out at a very high price to the US government. So capitalism, the creditism, was under extreme pressure as a result of this virus. Even before the virus, credit growth in the US, adjusted for inflation, had been just barely above 2%. As I mentioned, if credit grows by less than 2% adjusted for inflation, the economy goes into recession. So we've been just above that 2% recession threshold for quite a long time, a number of years. And with credit growth so weak, that wasn't enough to drive the economy. So the Fed had to engineer asset price inflation to supplement the credit growth, the weak credit growth, to make the economy grow. So the Fed cut interest rates to zero. They pumped in 3 rounds of quantitative easing. And anytime the stock market gave any indication that it was going to have a significant correction, the Fed would take some action, cutting rates or relaunching quantitative easing again in September last year, for instance, QE4. Whatever was necessary, the Fed did. It was the Fed. The Fed was a hostage to the stock market. If the stock market started to fall, the Fed would always become more dovish and do something to make it go back up again. So we needed asset price inflation to supplement credit growth to make the economy grow. So once this virus hit, not only were we in danger of credit contracting very sharply, but of course, all the asset prices fell very sharply. At one point, the stock market was down 35% in the first, and so that destroyed trillions of dollars of wealth. And that would have thrown the US into a very severe recession just by itself. So this combination of credit contracting and asset price crashing, that would have created, without any question, a new Great Depression in the United States and around the world. So we got the policy response. Now, here in Asia, where I live, we first felt the effects of the coronavirus a couple of months before the United States did. So it was pretty clear what was heading toward the US. And so starting in March 1st, I started publishing macro watch videos on the coronavirus. And on March 15th, I published a video called Recession or Depression. Will we just have a recession, or is this going to become a new Great Depression? And the answer to that question then, and it still is now, is it all depends on the speed and the magnitude of the government's policy response to this crisis. If the government spends enough, and if the Fed creates enough money, then they can keep the economy intact until we get through this virus. But if they don't, then the economy is going to collapse. And even when the virus ends, the economy will look nothing like it did when the virus began. So that was March 15th. Immediately after that, almost, the Fed on March 23rd, they announced what now has become known as QE infinity, where they announced that they would create absolutely as much money as necessary to keep the economy intact. And on March 26th or March 27th, President Trump signed the CARES Act, which pumped $2 trillion of fiscal stimulus into the economy. So the government did act very quickly, both with fiscal and monetary stimulus, and that's prevented a worst case scenario from causing the US economy to implode entirely. So, and by the way, March 23rd was when the Fed announced that QE infinity. That was the bottom of the stock market. It had been down about 35% at that point. Now it's recovered all of those losses. And in fact, NASDAQ is up roughly nearly 25% year to date. And that's a direct result, of course, of the Fed's monetary policy and supporting the government's fiscal policy.
Interesting. And Ira, what are your thoughts on the creditism view and your thoughts of the effects of the COVID pandemic on the economy and the financial markets?
Well, I mean, Richard, it's a very deep summation, and that's where we do lie. And the problem is, of course, as Richard talked about, and being, as we've talked about many times, the amount of debt that keeps building up in the system, just it's the inverse pyramid, because right now we're in a debt spiral, building and building and building. There's no getting around it. Everything that's going on. And now they're depending upon some forbearance, of course, in the United States on rents, student loans, all types of, and we can go on and on and on. Now, the debt is going to pile up. If the Fed is successful at creating the inflation, which inflation is the goal. Forget about 2%. It's a nonsense number. It's always been a nonsense number. It comes, of course, from the Bank of New Zealand with Donald Brash from the 80s as a target. And that was to get New Zealand under control. So that was almost like a sense of forward guidance and gave the market confidence. So everybody picked up on that. But I posed a question continually. If we come to December and the unemployment rate is at 9%, which I happen to think is optimistic, and inflation is at 6% on an annualized basis, which after the last two data points, even though I think the data points are for the most part ridiculous because it's not going to force the Fed to move anyway, but if the inflation on an annualized basis was at 6%, will the Fed raise rates? And everybody that I talk to, well, I will say 9 out of 10 will say absolutely not. And I think that's the point. Of course they can't. And as the debt piles up, as you've seen it, you've seen the impact. Today we had a lousy 30-year auction, okay? Rates backed up. Now, if these inflation numbers keep picking up a little bit, and listen, I know that 1 or 2 data, but that's such a silly discussion to have. 2 data points, certainly a trend does not make. But what it does is to doubt people who have piled in to the debt markets looking for some safety or cover. And now they realize that they have risk out there because you see it now. What happened to the 30-year today, it took a pretty good hit. And this is just the beginning. Now, traders and investors are, they're not the same. But traders who are looking for this, who would like to get short the long end of the U.S. curve, of course, are afraid of it because we know that the Fed will be in buying, just like the ECB is in buying. The Japanese don't even buy anymore. They just talk about it, and then they'll go over to the REIT market and some equities, and they might buy some foreign bonds. But they already own so much of the domestic market, it doesn't even make sense, so they just jawbone it. But this really creates a problem, and we're almost in a situation, as I explained to people, that the U.S. Treasury market is going to become like the JGB market, which famously was called in the 1990s when all the titans of the hedge fund world were trying to get short JGBs because Japanese debt was growing by leaps and bounds, and they were expecting, and fiscal policy was very loose, and interest rates were very low. And what did they do? They kept selling the JGBs, and it famously became known as the Widowmaker. Well, if the Fed officially announces yield curve control, that'll basically create a bunch of new widows on these shores for those who try to get short. So this is where it all lies. And the longer that we keep extending the credit out, you either do one thing. You either create inflation to relieve the stress or totally restructure the debt, or, under modern monetary theory, you just keep pumping until you get the inflation, and then you expect fiscal policy, because it assumed the modern monetary theory, by my reading, assumes that the electorate is responsible enough that they'll vote out people who don't start to contain the inflation. Well, I'm not going into that camp. I don't believe in that camp because history of the world tells me otherwise. So that's where. So everything that Richard talked about, that's where it lies. Where do we go from here? I don't know, but it's not pretty. And the Fed is caught, as Bernard Connolly would famously say, they're being hoisted on their own petard, and that's where it is. And the more debt that is created, the more frozen they are and caught in their own trap anyway. So I'll leave it there.
And so where do we go from here, do you think, Richard? Is it an unfolding stagflationary environment with high levels of inflation, given that creditism still plays?
Well, I agree that we are in a precarious situation, but I think that I don't think it's a doomsday scenario. It depends on government policy. I think if we do look at what has happened in Japan, people have been predicting doom there, as Ira mentioned, for decades. And what we've seen is Japanese government debt now has increased to 250% of Japan's GDP. Has that caused hyperinflation in Japan, or even 6% inflation, or even 0.6% inflation? No, Japan has been plagued more with deflation than with inflation. And the Japanese bond yield is 0%. And the Bank of Japan has created enough money. They now own 45% of all the Japanese government debt. And despite all of this government spending and all of this paper money creation, Japan is still doing quite well. I mean, Japan is a very rich country. You go there, everybody looks rich and prosperous and healthy for the most part. So how does the US compare with that? Well, before this crisis started, let's say at the end of last year, the US government debt, the GDP was roughly $21 trillion, and the debt was government debt. Government debt was roughly 110% of GDP. So even if the government spent another $21 trillion, the size of the GDP, and the economy didn't grow at all, which is unrealistic, then that would take US government debt up to just 220% of GDP. And so we would still have less government debt than Japan does now, much less government debt. And of course, if the government borrowed and spent money on that scale, the economy would grow by 5 to 10% every year, and we would never get to 200% government debt to GDP. So I believe the US government has a tremendous borrowing capacity, and that if it borrows, as long as it keeps borrowing and spending, and the Fed is there to finance this with paper money creation, then I think we can have the same sort of experience that Japan has had for decades. They've been borrowing and spending and monetizing the government debt and kept their economy from imploding for decades now. Their crisis started in 1989, 1990, 30 years ago. So I don't think that our economy is going to collapse anytime soon. As long as globalization doesn't break down, I'm not very concerned about high rates of inflation, because we saw there are three factors that cause inflation. Milton Friedman famously said that inflation is always and everywhere a monetary phenomenon, meaning if you increase the money supply too much, you always get inflation. But that's not true. There are two other factors that cause inflation as well. There are supply shocks and there are demand shocks. So in terms of supply shocks, there are inflationary supply shocks. For instance, the OPEC oil crisis. The OPEC cut off the oil, so we had inflation. But there are also deflationary supply shocks, and that's globalization. Because of globalization, it's extremely deflationary. The supply of everything, the capacity of everything is expanded tremendously. So what we've been experiencing predominantly up until now has been an extreme deflationary supply shock. But there are also demand shocks, inflationary demand shocks and deflationary demand shocks. Inflationary demand shocks are things like wars. You have a war, the government spends a lot of money, there's full industrial capacity, everyone's fully employed, you get inflation. But there are also deflationary demand shocks, and that's what the coronavirus is. Because of the coronavirus, demand has collapsed because everyone has been forced to stay home, and many people have lost their jobs and have less money to spend, so demand has collapsed. So the two dominant factors now are the deflationary demand shock caused by globalization and the deflationary supply shock that's still ongoing due to globalization. And I think these are going to continue to be the predominant factors, far outstripping the inflationary pressures caused by paper money creation that would have been dominant back in the days when gold was backed by money, but it no longer is. And so I'm not really too worried about a spike in inflation anytime in the foreseeable future, unless there's a total breakdown of globalization, which is not going to happen overnight.
And your thoughts, Ira?
Well, certainly I agree with, but I have to revisit Japan and what makes Japan different. And Richard being over in Asia is very well aware, is that Japan went into its crisis with massive amounts of savings. Number two is that to create the inflation that they spoke about would have been politically disastrous, especially for the LDP at the time, because 97% of domestic JGBs were owned by the populace, by the domestic market, unlike in the United States, which is certainly, as Richard pointed out, absolutely not true. So Japan realized real deflation Now, we've had disinflation. We haven't had deflation in the United States. And nothing says it more than what we've seen this week, right? We've seen two data points from the Bureau of Labor statistics. We saw a PPI, which was hotter than expected, and we saw a CPI, which was much hotter than expected. And then lo and behold, last night, we get the PPI out of Japan, and that was negative 0.9. So even today, Japan is still, prices are at least stable. So when I look at the yen and people say, well, why do you think the yen's going higher? I said, because when you look at real return on yields, when you look at real yields, the yen is a much better value than the US dollar. The US dollar is a supreme negative real yield, as is the euro, but the euro has been under pressure for a long time, so that's a little bit of a different story. But the yen, I don't know, I really question when I see the data, why Japanese institution and pension funds, insurance companies are busy scouring the world to buy bonds when what they're buying are negative yielding assets, and the cost of you can't really even hedge away the currency risk because there's not much there, a little bit. So I don't know what they're so busy chasing, except they don't want the yen to go back and, as they say, as they talked about in the even 8-9 years ago, the hollowing out of Japanese manufacturing. So they're being careful, but the world won't tolerate the Japanese gaining too much of a trade advantage. Even though the currency issues right now are not about trade; they're about global finance, and we can get into that a little bit deeper. But Japan is certainly a different case. In the U.S., all those points I agree with Richard. Globalization is a deflationary move on the global economy. Richard uses 1980, and he's going with Deng Xiaoping, white cat, black cat, it doesn't care as long as it catches mice. And then you throw in 1989 with the fall of the Berlin Wall and the opening up of Eastern Europe with another vast pool of labor ready to go to work. And you did have a deflationary impact. Of course, the only ones who didn't realize it were those who worshiped the Phillips curve, a domestic-based model that has improved itself in a long, long time, and yet the Fed has lent it so much credibility, and I think has rendered the Fed policy wrong, because the Phillips curve is just so bad, it's so flawed because of its domestic nature. When global capital chases and arbitrages labor on a global basis, to me, the Phillips curve stops to be of any importance, and therefore has really forced the Fed into some very bad decisions.
Well, what Ira was saying about the bond market this week is very interesting. Over the last, I think it was over 3 days, I was trying to add it up this morning. I think the Treasury borrowed 106 or 112 billion Tuesday, Wednesday, Thursday. That was my best count anyway, something like that. Now, of course, that's a large amount of borrowing in just a few days. And we've seen the interest rates go up as a result. As Ira mentioned, the auction last night on, I think, the 30-year didn't go very well. And so interest rates have moved up a little bit. Now, this is going to be very important, what happens here for the rest of the year. On August 3rd, the Treasury announced that it would be borrowing roughly $2.2 trillion during the second half of the year. Now, that would be something like $360 billion a month, an enormous amount. Now, the Fed has led the market to believe that it's going to create only $120 billion a month. That's what they said at their June press conference. And that's what the market has tended to expect since then. So that would mean that 120 is not going to be enough to finance 2.2 trillion or 360 billion a month. During the first half of the year, the Treasury Department borrowed $3.2 trillion, and the Fed created 2.8 trillion. So the Fed effectively created enough money to finance 88% of the government borrowing during the first half of the year. So in the second half of the year, if the government's going to borrow $360 billion a month, the Fed is going to have to create a whole lot more than $120 billion a month if it's going to prevent interest rates from going up, which it desperately wants to do. So we're at an interesting juncture here. I think it looks likely that the Fed is going to have to begin creating significantly more money than it's led the markets to expect. And if that in fact is the case, then the markets could respond very positively and we could see a significant further melt up in the stock market and further asset price inflation across the board before the end of the year, once it becomes clear that the Fed is going to begin printing much more money than it's indicated. However, these assumptions or these forecasts by the Treasury that it's going to borrow $2.2 trillion in the second half of the year, they have told us that they assume in those forecasts that the Congress is going to pass a new stimulus bill of $1 trillion. Now, this is interesting because it could end up that Congress actually passes a stimulus bill much larger than that. $1.5–2 trillion is not out of the question, in which case that would force the Fed to create even more money than I've suggested just now. But on the other hand, now that Congress is in a deadlock and seems incapable of reaching a new stimulus bill, we could experience just the opposite scenario. If the Fed, if the Treasury if the Congress doesn't pass this new $1 trillion stimulus bill, then the government could end up borrowing much less than $2.2 trillion in the second half. And the Fed would therefore end up printing much less money than the markets currently now expect. And in that scenario, we could see a real sell-off in the stock market sooner rather than later if the stalemate between the Republicans and the Democrats in the Senate carries on. So we're at an interesting juncture. We might see the Fed printing a whole lot more money than the markets currently expect over the coming months, or we could see the markets change their opinion entirely about how much money the Fed is going to create, in which case the bottom could drop out from not only the stock market, but the gold market as well.
What do you see as the most likely scenario in your perspective?
Well, who knows? I mean, is the honest answer. I believe the market believes that Congress will pass a large stimulus package. I heard someone from Morgan Stanley on CNBC last night saying they're looking for a $2 trillion rescue bill coming out sometime within the next few weeks. So I suppose what Morgan Stanley expects is something pretty close to what the consensus in the markets expect. And I believe that it is likely that Congress will pass a new rescue bill. I certainly hope that they do, because if they don't, the economy is going to weaken very rapidly as people begin defaulting on, again, their mortgages, their car payments, their credit card bills. They're not able to pay their rent, so we'll see people, hundreds of thousands to millions of people being kicked out of their homes within the next few months, and the economy will simply crash again. It would be a worst-case scenario if we don't get more government spending to keep the economy intact and get us to the other side of this virus. There's no reason the government can't afford to borrow more and keep the economy inflated until we get through this virus.
Mm-hmm. And your thoughts, Ira?
All good points made by Richard, but and I think when you listen to Trump and Mnuchin and whoever else they throw out there, and again, I preface this, just not one thing I make is a political comment. There's no partisanship on my part. This is, again, when it comes to policy, I'm like Deng Xiaoping. I don't care whether the cat is white or black as long as it catches mice and it's effective policy. But on this one, I think Trump actually outmaneuvered Schumer and Pelosi because he looks like he's defending Main Street. Because he's holding firm and saying no, because all you do is he said it over and over again today, you want $1.5 trillion to bail out cities that he keeps telling you are run by democratic regimes and have been so for decades upon decades, who are in multi-trouble, and that's not where the money is going to. So by executive order, they don't come to agreement, and they keep talking the trillion. The Republicans keep talking $3.5 trillion. There is a meeting point somewhere because they're all going to get cold feet. Because again, Trump, what is he talking about? He's talking about the things that Richard just worried about: forbearance for rent payers, payroll tax moratorium, student loan moratorium. These are all things geared to Main Street, and these are the things that he's getting done. The Democrats are really getting caught wrong-footed here, so they better make a decision pretty quick, because they're the ones he's going to keep pushing at them. And you know what? It's hard to get away from it. What are you fighting about here? A little bit here. We got to get on with this. So I think that Richard's right. We'll probably get to about 2.1 or 2.2 trillion. I mean, we throw these numbers around as, we're far away from Everett Dirksen. I grew up in Illinois, so, a billion here, a billion there.
Yeah.
When you're talking real money. So we do exist in this realm. And you know that the Treasury is geared up for this, because the Treasury General Account is at the biggest number, which, they're talking about is really tied up the Fed's hand a little bit, because you're over, I think, you're $1.6 trillion or $1.7 trillion in the Treasury General Account. And people would ask me, why is that? I said, well, because we just got numbers for the week. I mean, for July, and of course, the deficit was less than expected, but that was because the July 15th payments were due, which I paid mine after they were put off. So there was a big influx of money, but the Treasury knows going forward, revenues are down massively. It's part of why the Democrats want the money for the state and local governments, because revenues are down massively, and these deficits are going to explode. And I think that the White House was afraid of going into September, October with a budget battle. So right now, the Treasury is sitting on so much cash that they're not going to have a funding problem going into the election. It was actually a pretty intelligent move. And of course, the Fed has been forced to be to drive the getaway car. And that's what's going on. But I think Richard is right. There'll be a compromise, and it'll probably get to about 2.1, 2.2, and they'll curtail a lot of the Pelosi-loved programs, which they were hoping would support Democrats going into the election. But Trump, as they say, may have been born at night, but it wasn't last night, although sometimes they'll fool you. Maybe it was. But that's where it lies. So that's the situation. And I agree with Richard, as well as other people who I do respect on this issue. This is no time to be playing with this, because time is not your friend here right now, especially with the election. So they better get themselves together, or they're both going to get a good whooping come November, I think, all sitting politicians.
So the Treasury's forecast for second half borrowing, $2.2 trillion, assumes $1 trillion of additional stimulus rescue bills. If it turns out to be 2 instead of 1, then they will have to borrow $3.2 trillion in the second half, which would mean the Fed is going to have to create a whole lot more money than just the $120 billion a month that is indicated. And if that scenario were to play out, it seems pretty probable that we would see significantly higher asset prices, unless, of course, other things can go wrong. Things can always go wrong. Nothing is a sure bet when it comes to investing. For instance, a war with China would cancel all bets. But hopefully that won't come to pass. So if that sort of stimulus comes through, the Fed's going to monetize it, and that's going to pump enormous trillions more into the economy before the end of the year, making its way into the financial markets in all probability.
Richard, I think that's dead right on, which is why the equity markets keep powering ahead, because you don't have to just listen to the Fed. Yeah, we had the RBNZ the other night. They're on the same page. The Bank of England, same page. The European Central Bank, Lagarde is maybe, she says she's an owl, and I happen to, and I was never a Lagarde fan, but I think she's done a very good job in the current state of situation. But everybody, they see what's going on. I'm in the camp that, and I was ahead of the Fed on this because I said that back in early March, they should open up the swap lines to more people. When I was writing my Bible, written for a while, almost 2 months for certain, that they should open up the swap lines and they should cut interest rates because started out as an economic crisis, demand shock, supply shock. We had them all, but this is not a trade issue. So if the dollar is going down, I listen to the people analyze this. I go, we're not in a trade issue right now. This is a finance issue. And the global financial system needs a weaker dollar, especially now we've gotten part of it, because it will relieve some of the stress on the emerging markets who have borrowed up to 11. I'm using the BIS numbers or the Institute of International Finance, that non-government dollar debt in the emerging market world is 11 to 12 trillion. Well, when there's a shortage of dollars, as we saw in March, the dollar spiked higher, and that was death to the emerging markets and to others. The amount of stress in the global debt system, in the global financial system, was great. So, if this results in a weaker dollar, I think that you will continue to get financial markets revved up. And I think Richard's, totally right as to the outcome of that. When does it end? I can't tell you. My history with the yield curves, but we're not even going to see where we would normally see, like we did in 2010, 11, when the Fed first started down the road of QE in an aggressive fashion. We actually saw the yield curve steepen pretty dramatically, and then they reversed course when they realized, for many reasons, especially the interest on excess reserves, the money was not making it into the lending system, that the velocity was low, so the curves reversed and started to flatten. Now we don't know what's going to happen because Leo Brainerd and others have talked, and I think that is the next tool that they're going to pull out of the toolbox is the yield curve control. So we will not get any signaling mechanism from the marketplace. And that's probably the greatest danger of all. And where flattening curves would be negative equity markets, this time is going to be very, very interesting.
And that would be my final question is on the U.S. dollar. How does this all play out on the U.S. dollar index strength or weakness going into the U.S. elections and after the U.S. elections? Richard, your thoughts?
So the U.S. dollar, the dollar index has moved in a range roughly from when Bretton Woods broke down, I think it was around 97 in 1971. Since then, I believe it's been as high as 120 and as low as in the mid to low 70s. About a month ago, I did a macro watch video on the dollar and the outlook for the dollar. And at that time, it was exactly where it was at exactly its average since 1971. It was 97, I think. Now it's dropped to 93 something.
Are you talking on the dollar index? I'm sorry to interrupt. I just want to make sure I'm on the same page.
Yes, the dollar index.
Okay, thank you.
So it's amazing all that's happened over the decade since 1971. That just a month ago, the dollar index was at its average since 1971. So a lot of people express the concern that they think the dollar is going to collapse entirely and fiat money is going to disappear. Well, I don't believe that. The dollar will fluctuate up and down, but not within an enormous range. And after all the other central banks are also creating money on a very large scale as well. The European Central Bank, the Bank of Japan, the Bank of England, and China is up to its own money creation in different ways. So, which one is less attractive relative to the others? It's not at all easy to determine. And meanwhile, the U.S. trade deficit, which is still roughly $500 billion a year, that trade deficit keeps throwing out dollars into the global economy. that are accumulated by not only the exporters selling things in the United States and earning dollars, but the central banks of their countries who tend to create their own money and accumulate dollars for the purpose of currency manipulation. So there are going to be more and more dollars in the global economy because of the trade deficit. So the dollar standard is not going away anytime soon. And whether the dollar moves up a few percentage points or down a few percentage points, yes, I mean, it does matter. As Ira said, it's helpful for the global economy if the dollar weakens. It would also be helpful for the U.S. economy in that it would boost U.S. exports and deter imports. But I don't see huge movements in either direction.
And Ira, your thoughts for the U.S. dollar going into the U.S. elections and after?
Richard's point is well taken, and I actually read a few pieces on Project Syndicate today, and one by Eichengreen, who I have a lot of respect for, and he talked about the sensationalism. And Richard, I've talked about this. The dollar, and Richard's point is, in fact, I just ran the numbers. I can give you the 200-month moving average is 86 for the dollar going back. So I went and just did Richard's line because that's my thoughts too. If I take the 200-week moving average, the media sensationalizes it. As I said, the euro can go to 125, which would probably bring the dollar index down to about 87 and a half. It's no big deal. It's not like this move. It's nothing. Because if you take the bottom that was made, the top that was made in March of 2020, when there was a severe shortage of dollars, and Richard makes a really good point because you saw what happened to the precious metal markets. The gold got slaughtered as other things did because there was a great fear of deflationary spirals, turning on a hand, even though that would have rallied the gold eventually, because I always argue gold is much more fearful of deflation and reacts to it because it worries about central banks' reactions in a fiat currency world to deflation. But this is nothing. If we go back to 2008, and I got into that online discussion with people, who were going, oh, the dollar is going to go higher for this reason because Europe, and I go, every time somebody raises that issue, these same issues existed in 2008, and yet the euro was 160, right? Nothing's changed. Nothing's changed. All those issues are still alive in Europe. They made the mistake about how they crafted the whole European Union. They did it, as we would say in Chicago, ass backwards, because they should have created a fiscal harmonization, a common bond with the common currency. To do the one without the other was asking for trouble, and very intelligent people like even Martin Feldstein, I say even because I would put my weight with Rudy Dornbush, who wrote copious articles back in the 90s about it. So these are not new things, but if the dollar went down another 10%, meaningless. It's no big deal. And it would probably aid and abet the Fed getting a little more inflation, especially some commodity price inflation around the world, because that we know happens when the dollar gets weaker. We do get a boost in commodity prices, which would go a long way towards alleviating some of the pressure that we're seeing all over the globe in emerging markets who are dependent more on commodity prices. So, I mean, these are all part and parcel of the toolkit, although the Fed will never talk, as they stray away from talking about fiscal policy, although not quite as much as they used to. They will not discuss the dollar. But if I could sit down and have a discussion with Jerome Powell and ask him, would you prefer a weaker dollar or a stronger dollar at this point in time?
There's been some interesting action in the gold market over the last few days. People often say that gold is a hedge against inflation and has been going up because people fear that there will be inflation in the future. It's interesting to see what's happened just over the last few days. As Ira mentioned, we've had some higher inflation numbers, and gold has fallen quite significantly. Now, what happened? Well, what happened was the 10-year bond yield started going up. And so it seems that gold reacts more to interest rates going up than it does to inflation going up. That's, of course, because if the interest rates are higher, the cost of holding gold becomes greater because gold doesn't have any yield. Whereas, of course, if you buy a 10-year treasury bond, you get some yield. So the higher yields go, the less attractive gold becomes. And so gold seems to have ignored the inflation numbers this week and looked instead at the higher interest rates. Now, this will be interesting going forward because if the Fed doesn't create a lot more money and the government borrows a lot more money, then interest rates are going to go higher. It will be old-fashioned crowding out. But on the other hand, if the Fed creates a lot of money, it can finance all the government borrowing and hold the interest rates down. So you would think that the Fed creating a lot of money would cause gold to go higher. But we may be in a situation where if the Fed doesn't create a lot of money, then all the government borrowing is going to push interest rates higher, which could push gold lower. Now, I think what's likely to happen is that the Fed is going to hold the interest rates roughly where they are, and they're going to create a whole lot of money to do that. And the net effect of all of this new money creation is going to be to probably continue to push gold prices higher. And with the Fed creating as much money as they're likely to create over the coming months, I think it is probable that gold prices will keep moving higher along with stock prices. But they had better keep going higher. Gold had better keep going higher because we saw what happened back in, was it 2011? Then we were, I think, still in the second round of QE, and the biggest round was yet to come, QE3. But the price of gold fell from 1900 down to just below 1100 and stayed there until just now. It was a long wait to recover gold for it to recover its old high. So gold is not a sure bet. Having said that, I think it will probably go higher, but I wouldn't bet the farm on it. If it starts meeting resistance, and it could have another big correction the way it did in 2011.
Your thoughts, Ira?
Yeah. So as we sit right now, I just got there's a article online in the FT just came out as we're talking here. They're listening to us, Richard.
Okay.
Is U.S. Treasury forced to pay up to fund record stimulus? Not on your life. That's not going to happen because that's why they, of course, talk about yield curve control. Because if borrowing costs for the Fed were to ramp up, that would be politically disastrous because the deficit would increase enormously and would crowd out a lot of the discretionary spending programs that politicians love so much. So we're going to run into a dilemma here. But Richard, of course, is right. But you saw that because the algorithms ran wild. And I was kind of happy because I've been out of the gold. And I'm not a believer in gold reacting to inflation. I think by the time inflation comes, the gold has already run its course. And of course, it'll be the response to it. I'm much more a believer in a fiat currency world because central banks fear deflation more than they fear anything else. They always believe it's an asymmetric relationship because Paul Volcker taught them you can always stop inflation, but that's an old Schumpeterian viewpoint too, that you can stop inflation by raising rates. How far do you have to, where do you have to go to generate growth when things start collapsing? And that's what, to me, what they all fear, because that's Ben Bernanke with 1937. I call him a 37er, and I have for the last 15, 20 years, because he fears 1937 more than he fears anything else and the mistake that gets made. So you saw, and Richard's so right to point that out, as you saw the long end of the curve, as yields went up a little bit on Tuesday, Wednesday, you saw a pretty sizable sell-off in the gold and silver market, which had run way ahead of reality. But that's because people, again, were reacting to headlines with the sensationalism of the dollar and everything else that came with it. So you did see a correction. But I'm one who believes that the Fed's hands are tied. And as long as that's the case, that gold prices will push higher because at the end of the day, for for investors, real yields are the key to existence. And if in the United States, the policy has been, they tried to get away from it in the last quarter of 2018 with what Stan Druckenmiller referred to as the double shotgun approach of quantitative tightening and raising Fed funds rates. And we saw what it got, and we saw the Powell pivot in January of 2019. The Fed's hands are tied here. I think the gold market is going to keep pushing at them and say, well, we're going to keep buying until we get some more clarity. And I think that's a big problem that the Fed has put itself in a corner, because they should have put a sunset on this policy for 180 days. And if the economy hasn't turned in 180 days, then they go another 180 days. But at least the market would have a sense of where they're really going here. And there'd be no surprise, because if we really got the unemployment rate down quickly and maybe a little inflation, and then the Fed started to react, the market can't say, oh, there's a taper tantrum or there's some type of surprise. You'll know full well that that's going to be the response without surprising them, because the Fed is, ever since Bernanke taper tantrum reaction function in 2013, the market has owned the Fed, because they go about their merry way, and the Fed, if the Fed wants to counteract, then the market throws a tantrum and the Fed panics. So I can't tell you the timeline on this, but it's going to keep pushing until it discovers what the Fed really wants to do here.
Great. It's been an insightful discussion, and just wondering how our listeners can learn more about your work. Richard, you wanted to mention a special offer for your macro watch service?
Yes, thanks, Richard. Yes, so my business now is I publish a video newsletter called Macro Watch. And every couple of weeks, I upload a new PowerPoint presentation of me discussing something important happening in the global economy and how that's likely to impact asset prices. And one of the themes that runs through Macro Watch is that the economy simply doesn't work the way it did in the past when dollars were backed by gold. We have a different kind of economic system than we did then. A different set of rules apply. Classical economic theory no longer explains the way the economy works today. So what Macro Watch does is explains how the economy does work today, how it really works today, and how government policy affects not only the economy, but asset prices. So subscribers will receive one new Macro Watch video every couple of weeks, and they will also have immediate access to the Macro Watch archives, where there are now more than 70 hours of videos for subscribers to begin watching at any time, including 4 separate courses. So I hope your listeners will check that out. They can find Macro Watch by visiting my website, which is richardduncaneconomics.com. That's richardduncaneconomics.com. And if they want to subscribe, hit the subscribe button, and they will be prompted to put in a discount coupon code. If they use the coupon code September, they can subscribe to Macro Watch for a 50% discount. That's September, the discount code. And at the very least, they can sign up for my free blog and follow my work that way.
Great. And Ira?
Well, I've been on hiatus for 2 months from writing the blog, but it's Notes from Underground. But we are going to have a website built out. We're almost there. Ira Harris Underground. So we'll keep the Notes from Underground, which seems to attract a lot of, I think we got, Richard, about 5,500 regular readers, and I've been getting bothered. Why haven't I been writing? Because when we left off was on June 13th, 14th, and we left a very bullish gold and bearish the dollar. So people want to continue on and see where we're going. So I should be back up and writing Notes from Underground very soon. And otherwise, you have to find me at the Financial Repression Authority, because I have the great pleasure of doing a lot of these podcasts with you. So it's a good place to find me.
Great. Thank you so much, gentlemen. Thank you.
The FRA Roundtable Insight Show is for informational and educational purposes only. and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.